Today, the market was down bad. Specifically, one of the biggest companies we have, which is Nvidia, is down almost 10% in one day. The S&P 500 is down over 2%, and the growth ETF QQQM is down over 3%. Specialty sector ETF SMH, which is the AI ETF and semiconductor ETF, is down a whopping 7.5%. Side note, this is why I say be careful investing in any individual stock or even an individual specialty sector ETF, one that's been piping hot like semiconductors, because those are the ones that can drop the most in any one period. Nvidia's been on a tear all year, but then drops a huge 10% in one day. Just days after reporting that they beat analyst projections for Q2 of 2024. So even though the company profited more and did great, the stock still drops. And then for that specialty sector SMH ETF, since it's so heavily made up of just Nvidia and other semiconductors which are down, the whole ETF is down. But even though Nvidia is the third largest holding of the S&P 500, that index is only down 2%, making your portfolio much safer. Anyways, this report that I'm about to go over came out, and many analysts agree, and so do I, that the next 8 weeks are going to be quite volatile. I've been saying this all year, but this is incredibly important, specifically the jobs report.
Joining us now with this call for the markets on the first trading day of September is Tom Lee, Managing Partner and Head of Research at Fundstrat Global Advisors, as well as a CNBC contributor. And all along, Tom, when you've made these prescient calls, some of them even short term, it had to do with positive surprises on inflation. And is that going to be enough from here on out to keep the market headed higher, or have we shifted to growth worries now?
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting sort of in the middle of the month, but this week is the jobs report. I'm sure there's going to be a lot of focus on that.
Growth scare is what people are very worried about, because that report we got in July sent markets straight down. Inflation has been trending downward, and that's a good sign overall, which means the Fed has a basis to cut the rates down. But with jobless and unemployment up, that's bad for the economy overall, since that means less people will have money to even be able to spend. And if they stop spending money, then companies stop making profit. And if a company stops making profit, then we as investors will lose money in the stock market because the stocks are going to go down. And then those underlying companies within our ETFs that we like, that whole ETF is going to drop, and just overall, that's not a good sign. The main thing we need to see here is that we hopefully want to see the job support hopefully go up. So let's see what Fundstrat's Tom Lee has to say.
So what kept you positive was that the numbers were always, for the market, they were better than people were thinking. Is that going to continue to be the case? But it's no longer inflation, it's now growth. So growth will continue pretty good, jobs will continue pretty good. You're not worried about another growth scare like we had 6 weeks ago?
Yes, I think that the growth scare is what everyone's worried about, because the July jobs report was kind of a shock to markets, and that's part of how we had that Tokyo Black Monday. I think this jobs report for August is going to show a nice rebound for growth in jobs. Hopefully it's not too strong, because of course, as you know, if it's too strong, people are going to worry the Fed might backpedal on a September cut.
Now that was very interesting, and actually I thought the same thing. We want it stronger, but not too strong, because with inflation coming down, if that becomes too strong and everything just looks like it's totally fine, the Fed really wouldn't have a reason to pull the rates down. The only reason for the Fed to actually go ahead and cut rates is if it looks like there's a strain on the people, a strain on the economy, and by cutting that, that's going to be favorable. So we want to see some strength. We definitely don't want to be going down into crazy unemployment numbers, but we don't want it to be too strong, which is just such a hard balance to strike. So here's his take on what's going to happen over the next 8 weeks, and then I'm going to weigh in as well.
I think investors should be cautious for the next 8 weeks. September.
Next 8 weeks, be cautious.
Yes.
You're not always cautious.
That's right. When the market's been up 7 of the 8 months this year, so we know it's an incredibly strong market. But we also have the September cuts, and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a a chance to buy. So I think it's good to be cautious, but just ready to buy that dip.
Now I like the way that he phrased that. He said people will get a chance to buy, but he also said be cautious. And then he goes on to give an actual projection of what he thinks this next dip is going to actually look like. And I like specifically how he answered the question about when to actually buy the next dip. I'm also interested, are you investing right now, and what are you investing in over the next couple weeks? What's your outlook by the end of 2024? Comment that down below and let's see what everybody thinks.
Some uncertainty and caution going into the election, but in your view, people should get long.
I think they'll get a chance to buy long, yeah. So I think this is one of those where investors need to be cautious, but in the back of their minds, no, this is a strong market.
How far down? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. So it's kind of, it's been testing investors' patience. But I think, I think we should expect turbulence.
And then the question, of course, is when the turbulence comes, is it a buy the dip always?
I think
or is there going to be and by the way, buy the dip at when it goes down by 2 or 3%, or you really actually have to wait for a 5, 6, 7% pullback?
I think 1 or 2 is just almost like daily noise. This market has shown, pullbacks like that. So I think something like a 5% pullback is very likely, but I think we need.
And are you waiting for that?
Yeah, I think it, you know what, we'll find out this jobs report, because like if it's too strong and investors worry and so the stock market's down Friday, I would be buying that dip, but there's a chance that we get a good jobs report and the market's up. I hate to sound so binary, but I would just say at the bottom line is it's a strong market, so I don't think we've seen the top for 2024.
Now, I couldn't agree more with pretty much everything he said. I believe we're going to see a very volatile end to this year. And I definitely believe that we definitely need to be as cautious as possible, but that we're definitely not at the top and that we should be looking out for buying opportunities and continue to use this as buying opportunities as well. And real quick, when I say volatile, when he says volatile, whenever you hear that, that doesn't mean a down stock market. It means a crazy stock market. It means one where 1 week it's up, 1 week it's down. And that's tough to invest in because obviously we'd like it to just always be going up, and so you kind of put money in and then you make money psychologically. But it's actually better for investors if it's going down. If you buy it and it goes down for a while, now you get to buy it at cheaper, which means when it does inevitably go back up, you make a lot more money. The profit is much bigger during that type of a market. And that's what I think we're going to see over the next 8 weeks, but really over the next 6 months or so. If the market, like the S&P 500, were to drop 10% tomorrow, I would just throw my cash reserves straight in and be totally fine with it. Even if that meant that like next week it's going to drop another 10%. I will be okay with that because I know it's going to come back up just like it has every time. And I'm not going to be greedy or think that I have this crystal ball and know when the actual bottom is. I'm okay with it dropping 10%, 15%, something like that. I'm not going to wait for this huge 20 or 25%. I'm going to take the easy money and just go with it. Now, I will be putting money into good ETFs with low fees, something like the S&P 500 or any of the ones that I talk about for my 3 ETF portfolio. With this Nvidia drop today and the overall stock market drop, I informed my Patreon group what was happening right as it was happening. So if you want to be part of that group, it's only $20 per month. And we have live Zooms every 2 weeks and we discuss things like this. Check it out with the link down in my description right here. So now, yes, I'm interested to see what the jobs report has to say in the coming week, and then the rest of the news with the rate cut information from Mr. Powell down the road in the next couple weeks. I think we might see the market go up and then level out, or the market's gonna go down and level back out. I just really think that we can't put a finger on it. We can't really understand where it's going to go or what it's going to do. But by dollar cost averaging, especially into good broad style ETFs, I really think that that's the smartest move right now, other than holding a little bit of cash off to the side just in case. The biggest thing you can do is stay cautious and make sure not to invest with money that you're going to need in the next year. If you have money that you're saving up for like a down payment of a house in 2025, it's not a great idea to have that in the stock market right now. I'd pull that out and put it into a high yield savings account or money market account that gets a guaranteed 4% or something. That's better than hoping that you get 10 or 15% in the S&P 500, But with this volatile market, it actually drops 10%. That won't be great. Make sure you have an emergency fund, make sure you pick safe and sustainable ETFs, and make sure at the end of the day, you don't spend more than you make. Credit card debt is what's crippling America, and you're gonna get out ahead if you can just not do that. Watch one of these 2 videos to keep you going strong in your investing, and remember to keep investing simplified.